Howdy guys, today I wanted to talk a little bit about self-directed retirement plans. So when you have a job at a big corporation or even small companies, a lot of times there might be a retirement plan included, usually that you contribute to. Sometimes employers give matches, so you're like a 401k type of thing, or you can do IRAs that you can set up. And I don't pretend to be an expert on this, so I'm just going to hit some of the basics of the self-directed plan. So for those of you and like realtors that don't work for a big company, you can set up your own retirement plan that you can contribute to. So that way you're not missing out on the tax benefits. So there's two types of retirement plans, traditional or Roth. And what that means is how it's taxed, whether you're taxed now on the money that you put in or later on the money that you take out. And so you can end up saving a lot of taxes on the growth of your retirement plan with the Roth. And, like I said, I'm not an expert on this, but there are some big pros and cons to how you set that up. The point is, if you are self-employed, like a realtor, you can still contribute to a retirement plan, even if you don't work at a company that offers one. So with the self-directed part of the qualified retirement plan, like a 401k or an IRA, the self-directed means that you get to choose where the investments go. So if it's not self-directed, you're just putting it into a plan, and they'll usually put it in a mutual fund type product that'll hopefully grow over the years. They usually have it targeted by your age group. So if you're younger, it might be more aggressive, and if you're older, it might be more conservative. And you got a few options to pick from there depending on your age and how comfortable you are with the stock market and stuff. But with the self-directed, you get to pick where you want to put your money. So at first glance, what this means is that you might be able to just pick your own mutual funds or pick your own stocks if you're good at that and you are, like to analyze businesses and figure out which ones you think are going to go the furthest. But other than stocks and bonds and the typical Wall Street type of investments, you can also self-direct your retirement funds out of this retirement plan into all sorts of other non-traditional investments. So that's where it comes in big into play in my world as a real estate investor. I can have people invest into my business out of their retirement plan. So what that means is if they're directing it, they don't have to just pick Wall Street products. They can pick one of my products. Like they can actually buy real estate with their retirement plan, or more commonly in my world, that they would fund a project for me in the form of like a real estate note. And so they would have a mortgage on one of my properties and I would pay them interest so they know what they're getting back. And I've got other videos on private money, so we won't go diving too deep into that. But the point is, there's a lot of non-traditional investments that you can put your money into, like real estate syndications or other business syndications and private funds, and not just the Wall Street type products. Though if that's what you're into, you can still do that because it's self-directed. You can even hold it just as cash, not that I recommend that, but if you need, if you sold something, then had it in cash for a little while you're waiting for the next opportunity, you have that ability. So there's big benefits to doing this, is that the more money that you make in there, the more you're going to save in taxes if you have it set up as a Roth. So you can really grow your retirement plan and really save on taxes through one of these self-directed type of structures. So of course, when you're dealing with tax code, which is what retirement plans are, there's all kinds of rules and nuances and things. One of the bigger ones to be aware of on a self-directed retirement plan is that if your retirement plan purchases an investment, let's say it's a piece of real estate, all of the money that investment makes needs to go back into the retirement fund. So if you buy a rental property and it's making a profit, those funds go back into the retirement plan. You can't use that money now until your retirement age, or if you do, you have to pay the penalty for taking it out of your retirement plan. So that's one of the things, is that you can't just go buy a bunch of real estate. You can't go buy like a collector's car or something and call it investment and then be driving around. You can buy legitimate investments, but you can't use them now because that makes it look like you're cheating the tax code. The idea is to buy legitimate good investments that are going to help you build and preserve wealth until you're of retirement age. So that's the idea behind it. And there's other rules and things that go along with that, and there's different types. But the main point of this video I just wanted to say is that you don't have to keep your money necessarily just in your old company's retirement plan. Usually if you're not at that company anymore, you've got money in an old 401k, for instance, you can roll that either into your new company, or if they're offering a plan, or you can roll into a self-directed retirement type plan. So again, I'm not the expert authority on these things, but I have hired somebody who's helped me set mine up. And so I invest, my retirement funds into real estate notes and stuff. So if you have questions about that, reach out and I can line you up with the person who can get you all the answers that I'm not able to, and really help show you the pros and cons about the self-directed retirement plan. So thank you guys. I hope you guys have an awesome week, and we'll see you next time. If you guys have any real estate needs whatsoever, please reach out. In the meantime, please like, subscribe, share, follow, comment, and you can find me on any of these other places that you enjoy your content. So thanks very much. Really appreciate it.